Good afternoon, everyone. Welcome to the third video of White Cloud Wealth Management. Today we're going to be going over rules 4, 5, and 6 from Bob Farrell's Top 10 Rules for Investing. Rule number 4 is that market corrections do not go sideways.
So when this happens, profit takers begin selling their stock or other assets, which causes markets to move sharply. Profits are locked in by selling, and therefore eventually that can lead to a significant correction. As you can see, during market downturns, we typically have pullbacks, corrections, and bear markets. So pullbacks typically happen 2 to 3 times per year, and that's a 5 to 9% move. Corrections happen on average about once a year. So that's a 10 to 19% correction. And then bear markets, those tend to happen about once every 4 to 5 years. We hadn't had one for a very long time until this year, but in the case of 2020, Dave, we have experienced all three.
And so the question I ask, okay, so what do we do when we get these pullbacks, corrections, or when we enter a bear market? And from a behavioral perspective, the number one thing we can't do is be led by our feelings and have our emotions and feelings drive our reactions to what we might be seeing in the markets.
So what's a great way, Dave, to keep your emotions out of investing?
Yeah, I really think the only way is to kind of stick to your guns, stick to what are the rules and philosophies of investing that you've ascribed to and that have got you to where you are. What are those, and sticking to those regardless of the economic climate. At White Cloud, what does that mean for our clients and us? It means that we again look to buy companies at good prices, and then hold on to them as long as the price to earnings would say that it's still a good buy.
Still a good value, yeah. It's great. That brings us to rule number 5. The public buys most at the top and least at the bottom.
Yeah, Sean, a lot of us these days especially are going to rely on our phone or maybe a news feed or a podcast to get a lot of our information regarding the stock market and how's this stock doing, how's the economy doing, and whatnot. I think these are all great things to tune into on a limited basis. If we spend too much time listening to people report on things that have really already happened, we're going to get caught up in a place where all we're able to do is actually react instead of get out in front of things and make good decisions before they actually become good decisions. And really, it kind of creates that herd mentality. People want followers. People want as many clicks as they can on their news feed. And that's really kind of what we here call the herd mentality. And we really believe that independent thinking is going to always outperform herd mentality in the long run.
So in 2020, we've seen a lot of the herd mentality in the way of opening up new accounts. So we reported a few months ago in one of our newsletters that Robinhood investors had just opened up 3 million new accounts. Earlier in the year, it was reported that Fidelity opened up 1.2 million new accounts in the first few months of 2020. A lot of that is the herd getting in on the markets both before coronavirus entered the scene and after. And that's kind of what we're seeing in the markets and how investments and their prices are being bid up. So this goes back to that 5th rule that we're talking about, and that is investors tend to get involved towards the end of bull markets at their highest peaks, and then they aren't so excited to get involved when markets have sold off. So that brings us to rule number 6. Fear and greed can be stronger than long-term resolve. And that's the key as investors. We've got to have our long-term resolve.
Yeah, Sean, one of the biggest fears we're seeing out there today is this FOMO trade, the fear of missing out trade. And these trades are really driven by a natural bias that we all have to believe what's happened in the recent past is just going to continue on in recent future. Where when we take a step back and look at it logically, it's really not, it doesn't hold true. It's not a real world, or even especially in the financial markets, it's not realistic to expect um, these huge market bubbles to go on forever. These FOMO trades also really have a bit of envy and greed involved in them, in that we see our neighbor's success, or we see this stock success go up really quick and abruptly, and we want to experience that same feeling that they have. Unfortunately, when we have these types of stocks, and like Tesla, and you'll get into it in a minute here, that have these really sharp price movements, the more likely it is that that stock's price is actually going to reverse, and and we can end up getting ourselves into a rule of five, where we buy towards the top of the market, and it's really something we want to avoid at all costs.
And that brings us, Dave, to a little story I'm going to tell you about a company in the 21st century. Began as a technology company that started to make electric vehicles, and we all know it as Tesla. Tesla really started to take off in just after the down market of the 2009 2010 era, and they started to see that their profits, uh, not their profits, but their revenues started to grow, especially taking off in 2013 and beyond. You can see that they started out around $2 billion in 2013, and then their revenues grew to just 24 billion just this last year. And it's a company that's had a great, success over the last several years of having a real following, a crowd of people who are enthusiasts behind what they're making. And what's interesting though is you can see here in this chart, as they just started making a revenue in 2015, and that was where they were at, $2 billion. 2018 is really where they started to take off. They delivered about 40,000 cars in that second quarter of 2018, and then had another great quarter thereafter in the third quarter. But since that time, they've kind of been flat, delivering about 80 to 90,000 cars a quarter. And the revenues only grew by 3 billion between last year, 2018, and then 2019. That's only about a 14% growth, but yet their stock price has gone up by over 400%. So it doesn't really jive. It doesn't really logically match what's actually happened in the numbers. And the funny thing is, Tesla is worth more than General Motors today. General Motors is the biggest manufacturer of automotive, vehicles in the United States, and they do about $137 billion in revenue a year. And they're only priced, their market cap's like $45 billion. That's the worth of their company, is $45 billion. But yet Tesla's worth is $420 billion. So Tesla's only got 1% of the car maker market share, but yet they're almost 10 times the value of what the biggest car maker in the United States is. That tells you the fear of missing out, the greed that's involved here with investors. We're not really trying to tell you that this isn't going to be a great company in the future or anything of that nature. What we are saying, though, is it's a time, in our opinion, to be cautious with investing, because there's companies out there like this that are bid up too high, and that's just where the markets are at. So, Dave, how does this tie in all three rules that we're talking about today?
Yeah, good question, Sean. With Tesla specifically, looking at rule number 4, market corrections don't go sideways. When the market does correct for Tesla at some point, we believe it will. It could potentially correct pretty abruptly and sharply downturn back to a more, reasonable valuation. Rule number 5 is, if you remember, is the public buys most at the top and the least at the bottom. Just given this company's financials, the market share that they have in the auto industry,
It's a great illustration.
it's a great illustration of just people continuing to buy something when it's got to be extremely close to the top of where it can go, just based on financials and where they're at in their market segment. And rule number 6, it really just ties all of them together in that this fear and greed that we're seeing that in the market of people not wanting to miss this next opportunity, so much so that they're willing to pay exorbitant prices to see any sort of return is really what I think Tesla is a good example of in today's market.
Yeah. Well, thank you, Dave, and thank all of you for joining us today and going over Bob Farrell's rules 4, 5, and 6. We'll be topping it off with rules 9 and 10 this following month, as we did 7 and 8 at the very beginning. And hope you've enjoyed these, and we'll continue to do more interactive videos or videos to share educational elements with you. Again, thank you for joining us today, and we will take you to our disclosures.